thanks for joining us again for another episode of Ask Spurrell CPA. Today what we're talking about is accounting for fixed assets. I have May with me here now. May, so you have some experience in doing the fixed assets and some of our outsourced clients and going through that property, plant, and equipment listing.
Yes.
Each and every month. So the quote that we have for you today is Warren Buffett, all-time great investor, accounting is a language of business. And in terms of fixed assets, I'd like to point out 50% of all Canadian businesses are out of business in 5 years, but only 11% of those businesses seek professional help. Just 11%. Now imagine how many more we could keep on the tracks if they got some help. So the story is we review the interim financial statements of businesses, and these reports, they're supposed to give them the information that they need to make decisions. However, the transactions concerning their most major equipment, the vehicles, the leasehold improvements, real estate, they're booked incorrectly. And in turn, the income statements, the profit and loss statements that they're using, they're completely unusable. These transactions for major assets, property, plant, and equipment, they're big number transactions. They're booked incorrectly. That income statement is flat out unusable. So May, what are the questions you think these business owners should be asking?
I think they should be asking, what is a simple definition of an asset?
Yeah, so normally the simple definition of an asset that I would use is this is something that has a useful economic benefit of more than 1 year. So anything that you have that you purchase that has a benefit of more than 1 year. Now we're talking about an asset as opposed to an expense. So example, we buy some paper. Paper's going to be used up in a couple of months. We buy some advertising, it goes out every month. But if we buy a vehicle, we're not expecting to use up that vehicle in a year. We do some leasehold improvements and we fix up a space that we're going to operate out of. Those walls and the plumbing and the wires behind the walls, that's going to have a useful economic life, a useful benefit of more than 1 year. So that would be the simple definition that would be encouraging people to think about on their purchases. Is it something that's an expense, a useful economic life of less than 1 year, or is it an asset, a useful economic life, a useful benefit of more than 1 year?
What are some of the common types of fixed assets?
Yeah, so those types would be, starting from, let's say, vehicles are extremely popular. A lot of, especially contractors, are going to have vehicles on their balance sheet. Then you're going to have leasehold improvements, so the space that you lease, the space that you operate your business out of, those improvements to the space, putting up the walls, putting in the floor, putting in the ceiling, the plumbing, the electrical, the shelving, that is a fixed asset, so that would be included in what we call the property, plant, and equipment. Also major equipment, maybe we have a major CNC machine, even the computers. The computers, those would be something that have a useful benefit of longer than 1 year to the business. So it's those things. Also the real estate. So if you build a building, you own the land, those are the substantial items that these are fixed assets, we call them. They have a useful benefit of longer than a year.
Why do you normally not worry about assets with a cost of less than $1,000?
Yeah, we always got to be concerned about how much time we're putting into these records, and if that time is being spent on items that are what we call immaterial, or even beyond immaterial, that we call them insignificant. And so normally with most files, we would look at a material material limit of $1,000. So even if this item has a useful economic life of more than a year, let's say you buy a printer, you buy that printer from Best Buy, and that printer is $400. Yeah, you're going to use it for longer than a year, but it's not worth tracking it as a fixed asset. Just put it as an office expense here. The goal isn't to be 100% correct. The goal is to be materially correct and have an efficient accounting processes that you can accomplish the accounting work for an efficient fee, because ultimately we want to make money in business. So I normally draw that line at $1,000. At $1,000, I'm not going to worry about the economic life, the lifespan of the asset. It's an expense. More than $1,000, I'm going to ask myself, Does this have an economic benefit of longer than 1 year? If so, we're probably going to classify it as an asset.
When you purchase assets, should this expense show on your income statement?
So no, it doesn't belong on your income statement. Let's have that contractor, he goes out and purchases the truck, and the truck is $40,000. You know, his revenue for the month is $80,000. And he's got payroll of 40 grand, and he has rent of $5,000. It doesn't have another $40,000 auto expense in that month. That's not how it works. So really, that asset is going to go straight onto the balance sheet. It is going to bypass the income statement. So it's going to come out of cash, and it's going to go in as a fixed asset, and it's not going to show on the income statement right away, and it shouldn't, because you know that asset is going to be used to do the work, you know, for years at this point, not in one single month. So it shouldn't, you know, completely obliterate 1 month and make that net income on that 1 month look completely out to lunch.
When do these assets affect the net income?
So they affect the income statement when they're depreciated. So slowly over time, we're going to depreciate that truck. You know, if you're a dentist, you go out and buy an X-ray machine, it's not going to be expensed on, you know, the month that you buy it, but it's going to be depreciated over time. So usually those amortization entries, in most small businesses, we're going to book them annually. Some bigger businesses are going to start booking them monthly. I would question if that's necessary at a smaller scale. I think you got to have some real critical mass before that exercise is useful. You know, useful time, I guess, being invested in doing that exercise. So I would think each and every year you're going to book your amortization. We're going to depreciate that equipment at year end. And every single year we're going to depreciate that equipment, and the value of that equipment is going to go down and down and down, and slowly we're going to add that depreciation or amortization expense to the income statement in that year.
How does this satisfy the revenue and expense matching principle?
Yeah, so the matching principle is we should have the expenses matched to the income that they generate. So when we're looking at, you know, one particular time period, the income in that time period, we should have the expenses dealing with that income in the same time period. So whether we have to, you know, accrue for an expense that's going to get billed in a later period just so we can move it back here, or we have an asset and there's a big, huge expense right here in this month, we don't want it, you know, overshadowing that income in that period. We want it spread out over time, so it's matched to the revenue that asset is helping the business earn.
Is it a good idea to set up a sub-accounts for significant fixed assets?
Yeah, you'll get a lot of businesses where these fixed assets, they are the business. You know, let's say you're a rental company, especially, and you have, you know, 100 different pieces of equipment that you're renting out, and snowmobiles, quads, heaters, whatever it is. We want to know on an item by item basis, you know, what those assets cost us historically. If we just bury them all in vehicles, and you know, we have you know, 10 vehicles over the last decade, and then we try to go back later and figure out what that one cost us, you know, when it comes time to sell it, you know, we don't have as much information. So I would suggest that you know, creating these sub accounts for really significant assets are important. And it's not to say that you can't have one computer account for all the computer equipment in your business. I think it has to do mainly with the assets that would probably be sold on an individual transaction. That's probably the test that you want to look at. So when you buy this thing, you got to think to yourself, is this just going to be a piece of computer equipment that's going to be obsolete, and we're going to just toss it at someday, or donate it, or sell it for next to nothing? Or is this something that, you know, it's coming in for a significant price? You know, we're buying it at 40 grand, and someday we're going to sell it for a significant value, maybe $10,000 later on down the road. We want to know. We want to be able to capture that history. It can make it easy for insurance. It can make it easy for banks if they're issuing you financing. It can make it easy when you're selling the business, because you got a good list of all the significant assets as well. So I would encourage people to use those sub accounts for assets that have a real significant value.
If you see a small change in an asset account, what is the likely mistake?
Yeah, so if you have a small change, remember our recommendation is we got to ask ourselves: A, was this more than $1,000? And B, does this have a a useful life of longer than a year. So let's say you have a $50 increase in your computer equipment. Well, maybe someone went to Best Buy and bought printer ink. Or they went to Best Buy and bought that one little printer that doesn't really need to be added to the asset base. So again, usually when you have that small addition, it goes up by less than $1,000 in that asset account. Usually it means it was something that should have been expensed was added to the asset account, and that's kind of, just creating extra work, because that's something that's got to be added to the capital asset continuity schedule at the end of the year, and it's got to factor into the depreciation the calculation. It's quite frankly just not worth it if it's not big enough.
What does the book value of an asset mean?
So the book value is different than the market value. The book value is the cost of the asset less what we've depreciated since we bought it. So, we had a car, and most cars we can depreciate at 30%. So the first year is a half year rule. You can do 15%, and then we depreciate 30%. So let's say we have a car and we've depreciated, we've depreciated a $10,000 car. We've depreciated $3,000. So that depreciation expense is what showed up on the income statement so far. Now the book value is $7,000. So the $10,000 original cost, $3,000 depreciation over time, and then $7,000 is what's not yet been depreciated. That is the book value. And it can be different. It can be dramatically different than the fair market value of an asset. So it's important to know, is this the book value of an asset, or is it the fair market value of the asset? A lot of times the book value can be a good prediction of what the fair market value means, but we have to understand that the fair market value can also be different.
Does book value or fair market value show on your financial statements?
Yeah, most small businesses are going to have book value on their financial statements. Trying to quantify the fair market value of these assets on small business financial statements. To do that reliably, you're using expert appraisers, and it's kind of ridiculous. There's a lot of we're talking about big publicly traded companies who are using IFRS or International Financial Reporting Standards. Sometimes they have to report the fair market value, but small businesses, they're using the book value of assets. That's what's there. That's the simplest way to do it, and I can't think of a reason why small businesses would want to go through the trouble of calculating the fair market value of the assets, which really is kind of subjective anyways, because you don't really know how much it's worth until you try to sell it. So what's the point of calculating it when you intend to keep the asset and use it in your business? So I think that's what we have for today. Thanks so much for tuning in again. As always, hit the like and subscribe button so we can continue to bring you tips on how to beat the odds at business. And as always, if you have any questions, please leave them in the comments below, and we'll address your queries in a future video. Thanks very much.